We all know the story of Robin Hood, Prince of Thieves, takes from the rich and gives to the poor. But is Robin Hood going to steal your future retirement income? If you own mutual funds, there's a good chance he might. If you look at a mutual fund and if it's held of dividend producing stocks, so the makeup of your mutual fund is so you can receive dividend income. And what I want to go over here is the difference between mutual funds that are largely held with dividend producing stocks versus holding the same stock or stocks outside of the mutual fund. And what you're going to see here, this is Johnson & Johnson, and this is a history of its stocks over about a 3-year period, stock dividend. And this is the same period of time of what the actual dividend was paid out of the mutual fund. So the stock paid, one was inside the mutual fund, one was out. The owners that hold this stock or held the stock direct got paid the full dividend. What were the investors that got paid the dividend inside the mutual fund? If you go all the way back to in this chart, which is really from Yahoo Financial, if you go February of 2009, the dividend on Johnson & Johnson was about 50 cents a share for that quarter. The mutual fund only paid 27 cents a share. So even though the stock paid out 46 cents, the mutual fund investors only received 27 cents. The very next year was 49 cents. It was nearly 50 cents a share. The mutual fund didn't pay a single cent. Now there's a lot of reasons why. First and foremost, there's a lot of liquidity concerns in mutual funds. Money going in, money coming out. There's expenses. There's performance requirements. There's a lot of things that mutual fund managers have to do in order to show really good returns, which that's open for debate. The biggest is manipulation of dividend. Another thing when it comes to dividends inside of mutual funds is how they're taxed. So if you hold a stock direct and you receive the dividend, depending on how long you hold the stock, it's taxed at long-term capital gains rates or dividend income rates, which are going to be capped at 15 to 20% depending on your income. The vast majority of out there, it's going to be 15%. If you get that same dividend income from a mutual fund, it's ordinary income tax, which is going to be taxed at your highest rate because this is the last money you receive. Let alone of the fact that if you look at what stocks pay from a dividend standpoint versus what the average mutual fund pays, it's about 40% of the actual payment. So if you're receiving roughly $1 in dividend, in the mutual fund, you'll get about 40 cents. That's a huge concern. Why would you give away or allow mutual funds to rob you of that income? I'm not a huge fan, as you can tell, of mutual funds, and this is the reason why. There's no bigger concern in America today, in my opinion, than the concern of running out of money or not having enough income in the future. And this is why. Mutual funds don't pay the full yield, the full dividend. They take it for lots of different reasons. Just go direct. Go right to the stock. You don't have to worry about the tax concerns that are held inside of mutual funds. And you're not going to have to worry about the mutual fund managers taking your hard-earned retirement income away from you. My name is Paul Durso. Hope you learned a little bit about the difference between receiving dividends straight from a stock versus a mutual fund.